Hi everyone, my name is Shazia Khan and the unit we'll be doing today is company law, which is J618-7920, and we'll be doing learning outcome 1 today. And the learning outcome 1 is looking at understanding legal issues affecting companies through the analysis of characteristics, incorporation functions and regulatory framework. So we'll be looking at that. And then we've got another 3 learning outcomes plus the assignment discussion session. So moving on to the next slide, the unit aim is to provide information about English law relating to registered companies. So how companies register, what types of companies we have. We'll be looking at private and public limited companies, and the learners will gain a knowledge and understanding about the legal issues affecting companies, the rights, the obligations of shareholders and directors, and the legal procedures related to corporation liquidation. So that's what we'll be concentrating on in learning outcome 1, which is the first learning outcome. We'll now move on to the indicative content. So we'll be looking at, in the indicative content, at the characteristics of the sole trader, partnership, public and private companies, functions and regulatory framework for company law, theories and policies, issues of company and corporate objective, the corporate veil, judicial and statutory lifting of the corporate veil. We'll also be looking at articles of association, so amendment, entrenchment and enforcement. There's a video here that you can look at in your own time, and it looks at the elements of different types of businesses such as sole trader, partnership, limited company. So that video you can look at in your own time. So 1.1, we're looking at analysing the characteristics of the sole trader. So firstly, is sole ownership. So sole traders operate their businesses as single individuals without the need for partners or shareholders. So it might be that you may want to set up a corner shop or a barber's shop or a mobile phone shop. So you will set that up as a sole trader. Unlimited liability. Sole traders are personally liable for all their debts and obligations of the business. There's no legal separation between the individual and the business entity, exposing the sole trader's personal assets to business liabilities. Direct control. Sole traders have complete control over the business decisions and operations. They have all management and financial and strategic independence. Strategic decisions independently. So they make all the decisions. They have the full control. They're able to control their business, what goes in, what goes out. So they're able to manage it as they want. The ease of formation. So establishing a sole trader business is relatively straightforward and involves fewer legal formalities compared to other business structures. It's typically obtaining necessary licenses and permits, registering the relevant authorities and fulfilling tax obligations. So it's not a rigmarole of doing it like partnerships and limited companies. It's quite easy to set up a sole trading business. Taxation. Sole traders report business income and expenses on their personal tax returns. So self-employment, they are subject to individual income tax rates, and business profits are taxed at personal income. Limited resources. Sole traders may face limitations in terms of resources, capital and expertise compared to larger corporate structures. They rely solely on their personal funds, skills and abilities to operate and grow the business. So if you want to grow your business, you would have to use your own finances to try to make the business more, there's more growth in it, and also try to make your business expandable. Limited continuity. So the continuity of a sole trader business is directly tied to the individual proprietor. The business ceases to exist upon the death or incapacity of a sole trader unless arrangements are made for succession or transfer of ownership. So it's literally the sole trader is the one that will take everything on account. Privacy. Sole traders greater privacy as they are not required to disclose financial information or business operations publicly, except as required by taxation or regulatory authorities. The next one we're going to look at is partnerships. So the partnership business structure is categorized by multiple owners. So partnerships involve two or more individuals, which are referred to as partners, who join together to carry on a business with the view of a profit. Mutual agency, so each partner acts as an agent for the partnership and has the authority to bind the partnership to contracts and obligations entered into within the scope of partnership's business. Shared profits and losses, so partners share it. So it's not like the sole trader where they have the sole responsibility. Partners actually share this profit and losses of the business according to the terms outlined in the partnership agreement. Typically, profits are distributed among partners based on their agreed upon sharing ratio. So it's not like sole traders where they have the full responsibility and they don't have to share the profit with anyone. Whereas in a partnership, you have two or more individuals, partners, and the profit would be shared in regards to what it was agreed. So, you know, maybe 10%, 20%, depending on what was agreed in the partnership agreement. Unlimited liability. So in general, a partnership, partners have joint and several liability, meaning each partner is personally liable for the debts and obligations of the partnership. This exposes partners' personal assets to business liabilities. Partnership agreements are governed by a partnership agreement that outlines the terms and conditions of the partnership, including things like profit sharing arrangements, decision-making arrangements, management responsibilities, and dispute resolution. So they all have a part in it. All the partners will play a role in the business. And this will be all in a contract. Taxation. So partnerships are not subject to separate taxation. Instead, business profits are distributed to partners who report their share of partnership income and losses on their individual tax returns. Partnerships file an informational tax return from 1065 in the United States to report the business's income, deductions, and credits. Ease of formation. Establishing a partnership typically involves fewer legal formalities compared to corporations. Partnerships may be formed orally or through a written partnership agreement, although it is advisable to have a written agreement to clarify rights, responsibilities, and obligations. The limited continuity. The continuity of a partnership may be affected by changes in partnerships, composition such as admission, withdrawal, or death of the partners. Unless otherwise specified in the partnership agreement, the partnership dissolves upon the departure of a partner. So a lot of things change. There are partnerships in place. Sometimes someone dies, then it all has to get changed and dissolved. Shared management. Partners generally have the right to participate in the management and decision-making processes of the business. However, the extent of each partner's management authority may vary depending on the partnership agreement and the nature of the partnership business. Public and private companies. So public company, the ownership of public companies have where companies issue shares to the general public, allowing anyone to become a shareholder by purchasing shares through a stock exchange or other public markets. Number of shareholders. So public companies typically have a large number of shareholders, which can range from hundreds to millions. Disclosure requirements. So public companies are subject to extensive disclosure requirements imposed by securities, regulations, and stock exchanges. They must regularly disclose financial information, operational data, and other material information to shareholders and the public. Regulatory oversight. So the public companies are subject to stringent regulatory oversight by government agencies such as the Securities and Exchange Commission, SEC, in the United States, or the Financial Conduct Authority, FCA in the UK to ensure compliance with securities laws and regulations. So compared to the partnership and the sole trader, this is more, it's more stringent in regards to, you know, trying to identify any sort of issues with securities or any sort of external agencies they have to work with. So it's a lot more stringent. And you have to comply with a lot more laws and regulations. Corporate governance, public companies often have complex corporate governance structures, including board of directors, committees, and internal controls to safeguard shareholder interests and ensure transparency and accountability. Access to capital. So public companies have access to capital markets for raising funds through the insurance of equity, which is shares, and debt securities, bonds, or debentures. They can raise substantial capital from investors to finance growth, expansion, and the investment opportunities. Liquidity of shares. So shares of public companies are traded on stock exchange or other secondary markets, providing liquidity to shareholders who can buy or sell shares easily. Market valuation. So public companies' market value is determined by the stock market, where share prices fluctuate based on supply and demand dynamics, investor sentiment, and company performance. Private company. So the ownership are owned by a limited number of shareholders, often including founders, family members, or a small group of investors. Shares are not available for purchase by the general public. So compared to the public company, these shares are not available by the general public. Number of shareholders. So private companies have a smaller number of shareholders compared to public companies, which have a larger number because it's open to the public. They have a few shareholders or to be wholly owned by a single individual or an entity. The disclosure requirements are that private companies have fewer disclosure requirements compared to public companies. They are not obligated to publicize, disclose financial information or operational data, except as required by regulatory authorities or in specific circumstances. So regulatory oversight of private companies. Private companies are subject to less stringent regulatory oversight compared to public companies. They must comply with applicable company law and regulations, but are not subject to the same level of scrutiny as public companies. Corporate governance. So private companies may have simpler corporate governance structures compared to public companies. Governance mechanisms are often tailored to the specific needs and preferences of the shareholders and may include formal, informal arrangements or agreements between them. Access to capital. So private companies have limited access to capital compared to public companies. They may rely on internal sources of funding, such as bank loans or private equity investments to finance any sort of operations, growth, and expansions they want. Liquidity of shares. So shares of private companies are not traded on public exchanges, making them less liquid than shares of public companies. Shareholders may face challenges in selling their shares or exiting their investments. Ownership control. So ownerships of private companies have greater control over business decisions and operations compared to public companies, as they are not subject to influence of public shareholders or any sort of market pressures from the outside world. So it's more to do with the public shareholders. And in a private company, they have control of their own shares or any sort of business decisions or operation of the company. Whereas in a public company, it's more the shareholders, as it's the shares are available to the public. So 1.2, evaluate different functions of EU companies. So the functions of EU companies can be evaluated based on several key aspects. Firstly, economic function, which is EU companies play a crucial role in driving economic growth, innovation, and competitiveness within the EU single market. They contribute to GDP growth, and job creation and wealth generation, fostering prosperity and development across the member states. The next function is market integration, and this is where EU companies facilitate market integration by actually operating across borders with the EU single market. They benefit from the free movement of goods, services, capital, and people, enabling them to expand their activities, access larger consumer markets, and leverage economies of scale. Next function is trade and investment. So EU companies exchange in cross-border trade and investment activities, both within EU and with external partners. They contribute to trade flows, export growth, and foreign direct investment, which is FDI, enhancing the EU's position in the global markets and fostering internal economic relations. Innovation, another function is innovation and research, which is EU companies are at a forefront of innovation and research, driving technological advancements, product development, and scientific breakthroughs. They invest in research and development, R&D, collaborate with academic institutions and research centres, and participate in EU-funded innovation programmes to create new products, services, and solutions. The next function is employment and social function, which is that EU companies are major employers, providing job opportunities and livelihoods to millions of workers across various sectors and industries. They contribute to social cohesion, labour market stability, and skill development, promoting inclusive growth and prosperity. Another function is corporate governance and responsibility. So here, EU companies adhere to principles of corporate governance, transparency, and accountability to ensure sound management practices, mitigate risks, and protect shareholder interests. They also embrace corporate social responsibility initiatives addressing environmental, social, and ethical concerns and contributing to sustainable development goals. Another function is compliance and regulation, where the EU companies must comply with EU regulations, directives, and standards governing various aspects of business operations, including competition law, consumer protection, environmental regulations, data privacy, and corporate governance. Compliance ensures legal certainty, market integrity, and consumer confidence. Another function, and the final one, is international competitiveness. And these EU companies compete globally in diverse sectors, such as manufacturing, technology, finance, and services. They strive to enhance their competitiveness through innovation, so any sort of new products, any sort of new developments, efficiency, quality, and branding, positioning themselves as leaders in international markets and driving the EU's economic influence worldwide. Now, to conclude this part, which is sorry, sorry about this. So in conclusion, by evaluating these functions, policymakers, regulators, and stakeholders can assess the performance, impact, and challenges faced by EU companies. And they can formulate strategies to support their sustainable growth, resilience, and competitiveness in an evolving economic landscape. And that is a conclusion to 1.2. So now we're going to go on to look at 1.3, which is to evaluate regulatory frameworks of incorporation of UK and EU companies. So the regulatory frameworks for the incorporation of UK and EU companies can be evaluated based on several different key factors. So the first one being legal structure and requirements. So for the UK companies, in the UK, companies are incorporated under the Companies Act 2006, which sets out the legal framework for any sort of company formation, governance, and operation. The Act defines different types of companies, such as private limited company, LTD, and public limited companies, PLC, each with specific requirements regarding share capital, directors, shareholders, and reporting obligations. Whereas in the EU, within the EU law, directives provide a common legal framework for company formation and operation across member states. Directives such as EU Accounting Directive and EU Shareholder Rights Directive harmonise rules relating to accounting standards, disclosure requirements, shareholder rights, and corporate governance practices. So there's a difference between the legal structures and the requirements for UK and EU law. So the incorporation procedures, so within UK companies, incorporating a company in the UK involves submitting the necessary documents, including the memorandum and articles of association, to Companies House, which is the main company that deals with everything, the UK's registrar of companies. The process typically includes choosing a company name, specifying the company's registered office address, and appointing directors and shareholders and issuing shares. And then within EU, the incorporation procedures for EU companies varies depending on the member states' national laws and regulations. So each member state has different laws and regulations which must be followed. So for the UK, it's Companies House. For any other country, the laws, the jurisdictions and regulations will be different, but they must be followed. However, EU directives aim to streamline incorporation processes and reduce administrative barriers by enabling companies to register and operate across borders within the EU single market. Share capital and liability. So for the UK companies, UK company allows for various types of share capital structures, including authorised share capital, issued share capital, and paid up share capital. Shareholders' liability in UK companies is limited to the amount unpaid on their shares, except in cases of fraud or wrongful trading. And for EU, the share capital and liability for EU is that EU company law directives establish minimum requirements for share capital and liability, allowing member states to determine specific rules within their national legal framework. Many EU countries have adopted limited liability company structures similar to those in the UK, providing shareholders with limited liability protection. Corporate governance and reporting, and for the for the UK companies, they are subject to corporate governance codes such as the UK Corporate Governance Code, which sets out principles of good governance, board effectiveness, and transparency. Companies are required to prepare and file annual financial statements, directors' reports, and other regulatory disclosures within Companies House. For EU companies, the EU directives on corporate governance and reporting aim to enhance any sort of transparency, accountability, and investor protection across member states. Companies must comply with EU accounting standards, IFRS, and disclose financial information in accordance with EU regulations. The EU also promotes shareholder engagement and participation through any sort of directives such as shareholders' rights directives. For cross-border operations for the UK companies can operate and expand their activities across EU borders under the principles of freedom of establishment and freedom to provide services within the EU single market. However, Brexit has led to changes in the regulatory landscape for UK companies operating in the EU and vice versa, with potential implications for cross-border trade, investment, and regulatory compliance. For cross-border operations for EU companies, EU directives facilitate cross-border operations for EU companies by harmonising rules on company law, accounting standards, and corporate governance practices. EU companies can establish subsidiaries, branches, or joint ventures in other member states, and benefit from simplified procedures for cross-border mergers, acquisitions, and restructures. In conclusion to 1.3, overall, while the regulatory frameworks for the incorporation of the UK and EU companies share common principles and objectives, differences in national laws, regulatory regimes, and Brexit-related developments may impact the ease of doing business, regulatory compliance, and cross-border operations for companies within UK and EU. So ongoing regulatory reforms and cooperation efforts at both national and EU levels aim to address these challenges and promote a favourable business environment for companies across the UK and EU. Now we're going to go look at 1.4, and that is to evaluate the Articles of Association, and this can be enforced. So the Articles of Association serve as a critical document governing the internal management and operation of the company. Evaluating the articles involves considering their content, enforceability, and significance in regulating the company's affairs. Here's an evaluation of the Articles of Association and their enforceability. So content of Articles of Association. So you have the governance structure, which is articles that outline the company's governance structure, including the roles and responsibilities of directors, shareholders, and officers. Then you have the share capital, which are articles that specify the company's share capital structure, the rights attached to different classes of shares, and procedures for issuing and transferring shares. Then you have the decision-making procedures, and these are articles define procedures for convening meetings, voting rights of shareholders, quorum requirements, and resolutions. And then you have the management powers, which the articles delineate the powers of directors and management, including their authority to manage the company's business and affairs. Then you have amendment procedures, which are articles establish procedures for amending and updating the articles themselves, ensuring flexibility to adapt to changing circumstances. So the enforceability of Articles of Association. So the legal basis, Articles of Association form a contract between the company and its members, as well as among the members themselves. They are legally binding on the company's shareholders, directors, and officers. Statutory framework, articles must comply with statutory requirements and company law regulations. And this is really important when it comes to any sort of documents that in regards to Articles of Association. Any provisions that contravene statutory provisions or public policy may be unenforceable. Shareholder agreements. So in closely held companies, shareholders may enter into separate shareholder agreements that supplement or modify the articles. Courts generally uphold shareholder agreements as long as they do not conflict with the articles of or the company's law. Directors' duties. Articles may contain provisions specifying directors' duties and obligations. Directors owe a fiduciary duty to the company and its shareholders, which may be enforced through legal action if it's breached. Shareholders' rights. Articles delineate shareholders' rights, such as voting rights, dividend entitlement, and preemption rights. Shareholders can enforce these rights through legal action or by challenging company decisions that violate their rights. Dispute resolution. So articles may include provisions for resolving any disputes among shareholders, directors, or between the company and its stakeholders. Dispute resolution mechanisms such as arbitration or mediation clauses provide alternative avenues for resolving disputes. The significance of articles of association. So for internal governance, articles of associations establish the framework for internal governance and decision-making within the company. They promote clarity, consistency, and accountability in corporate governance practices. Investor confidence. They are clear and comprehensive articles which enhance investor confidence by providing transparency regarding the company's governance structure, rights, and obligations. Investors can assess the company's governance practices and make informed investment decisions. For the legal compliance, articles ensure that compliance with company law regulations and statutory requirements. Companies must adhere to their articles and act within the bounds of their authority to avoid any sort of legal challenges and regulatory sanctions. Flexibility and adaptability. Articles allow companies to tailor their governance arrangements to suit their specific needs and circumstances. Companies can amend their articles to accommodate changes in ownership, management, or business strategies. Conflict resolution. Articles of association serve as a reference point for resolving conflicts and disputes within the company. There's clear provisions regarding decision-making, shareholder rights, and dispute resolution mechanisms facilitate the resolution of conflicts in a fair and orderly manner. In conclusion to 1.4, articles of association play a crucial and a pivotal role in governing the internal affairs of a company and regulating their relationship between its stakeholders. They are legally binding documents that establish the company's governance structure, rights and obligations, and provide a framework for the resolving disputes and promoting transparency and accountability. Enforcing the articles ensures any sort of compliance with the legal requirements and promotes investor confidence in the company's governance practices. So, using the articles of association is really, really important in any company to regulate, any sort of relationship of the company and make sure that you are following the legal requirements of the company and the rights and obligations and governance of the country to make the company more effective and to work better and follow the legal requirements and promote this to other investors as well. So now we'll go on to 1.5, which is to analyse the effect of corporate veil and how this can be lifted. So the corporate veil refers to the legal separation between a company and its shareholders, directors and officers. It shields individuals from personal liability for the company's debts, obligations, and legal liabilities. Analysing the effect of corporate veil involves considering its benefits, limitations, and circumstances under which it can be lifted. So the effects of corporate veil. So for limited liability protection, shareholders, directors, and officers of a company enjoy limited liability, meaning that their personal assets are generally protected from the business debts and liabilities. Creditors can only pursue the company's assets to satisfy their claims, not the personal assets of its stakeholders. Encourages investment. So limited liability encourages entrepreneurship and investment by mitigating the risk of financial loss for investors. Shareholders are more willing to invest capital in the company without the fear of personal bankruptcy or liability beyond their investment. Separate legal entity. So a company is treated as a separate legal entity distinct from its shareholders and directors. It can enter into contracts, own property, sue and be sued, and engage in legal transactions in its own name, independent of its stakeholders. The business flexibility. So the corporate structure allows for flexibility in ownership, management, and succession planning. Companies can attract investors, appoint any directors, and transfer ownership interests without disrupting business operations or exposing stakeholders to personal liability. So circumstances for lifting the corporate veil. Fraud or wrongful conduct. So courts may lift the corporate veil to hold individuals personally liable for fraudulent or wrongful conduct perpetrated through the company. So if stakeholders abuse the corporate form to defraud creditors, evade any sort of legal obligations, or perpetrate illegal activities, courts may pierce the corporate veil to hold them accountable. Things like, defrauding or money laundering or anything like that, the courts have that right to obviously lift the corporate veil at that time. Agency or alter ego. If a company is merely an alter ego or agent of its shareholders or directors, courts may disregard the corporate form and hold individuals personally liable for the company's obligation. This typically occurs when the stakeholders commingle personal and corporate assets, ignore corporate formalities, or use the company as a facade for their own personal affairs. Undercapitalization. So this is if a company undercapitalized or lacks sufficient assets to meet its foreseeable liabilities. Courts may pierce the corporate veil to protect creditors and ensure fairness. Shareholders cannot shield themselves from liability by intentionally undercapitalizing the company or draining its assets to the detriment of creditors. Then you have group of companies. So in cases involving complex corporate structures or groups of companies, courts may pierce the corporate veil to prevent injustice or unfairness. If companies within the groups are interrelated or controlled by a common entity, courts may hold the group's ultimate controllers liable for the debts of subsidiary companies. Methods for lifting the corporate veil. Directors' liability. Directors can be held personally liable for their actions or omissions. So if anything does happen, directors can be held liable. If they breach their fiduciary duties or engage in fraudulent conduct or act beyond their authority. Shareholders' liability. Shareholders may be held personally liable if they abuse the corporate form or engage in fraudulent or wrongful conduct to the detriment of creditors or their third parties. Court intervention. This is where courts have the authority to pierce the corporate veil and hold individuals personally liable for the company's debts or obligations if they find evidence of fraud, wrongdoing, or any sort of injustice. In conclusion to 1.5, while the corporate veil provides essential benefits, such as limited liability protection and business flexibility, it's not absolute. Courts may lift the corporate veil in exceptional circumstances to prevent any sort of injustice, because this does happen within any sort of companies. Protect creditors, and it also would lift that to hold stakeholders accountable for any fraudulent, wrongful conduct. Stakeholders should adhere to legal requirements, maintain corporate formalities, and act in good faith to preserve the integrity of corporate form and avoid any sort of personal liability. The effect of lifting or piercing the corporate veil is that shareholders, rather than the company, are regarded as the relevant actors on whom liability of the obligations of the company are placed. And as we've mentioned, there are so many different ways in where the courts have the liability to lift the corporate veil, and the circumstances in which they may do this to prevent any sort of fraudulent activity or any sort of injustice that's occurring. So we've finished learning outcome 1 in regards to the company law unit. The references we've used for today's session are listed there, which you can look at in your own time. So there's a variety of references that you can refer to when completing the assignment, but also there's additional reading on Moodle that you can refer to. Again, some more references just there. Some good books in regards to looking at the corporate governance, the political determinants, corporate governance, and directors' accountability, and corporate law as well in regards to it. And there's some articles on company law reform in the UK, which looks at report on international company and commercial law review. Preliminary is that there's further ebooks, as I've just mentioned, on Moodle, and journals on Moodle that you can look at for this unit. Please refer to Moodle for any further reading. There's journal articles and additional information on Moodle. Any queries you have in regard to this unit, please email learnerwork@ukvarsity.co.uk, and any submission of the assignment to be done 2 weeks after the unit has been completed needs to be submitted on learnerwork@ukvarsity.co.uk. Thank you for attending this session, which is learning outcome 1, and the next learning outcome we'll be doing is learning outcome 2, which is tomorrow. Thank you. Thanks.